Every politician promises fiscal responsibility, balanced budgets, a strong dollar for generations. But behind the speeches and campaign pledges, a deeper system quietly operates. The United States holds a unique privilege. It controls the world's primary reserve currency. The Federal Reserve can create dollars at will. No other nation has this power. Yet the country carries a debt exceeding $38 trillion as of early 2026. Interest payments alone surpass $1 trillion per year. That is more than the defense budget in many recent years. Your taxes help cover these obligations. And over time, future generations inherit an even heavier burden. This situation seems paradoxical. How can a nation that prints the world's most accepted currency still face such massive debt? The answer lies in history, policy decisions, and patterns of borrowing and repayment. The story begins in the founding years. The Revolutionary War left the young nation deeply indebted. By 1791, the federal government owed over $75 million, mostly to foreign lenders and nervous domestic creditors. Many feared default. Some looked at older republics and saw collapse under smaller debts. Alexander Hamilton, the first Treasury Secretary, introduced a bold solution. He convinced Congress to assume all state debts, consolidate them under one federal authority, fund them with new taxes and long-term bonds. Confidence returned. Creditors were reassured. Investment flowed back into the young nation. Growth accelerated. The system worked brilliantly for a time. By 1835, under President Andrew Jackson, the federal debt was fully paid. It was the only time in American history the national debt reached zero. The lesson seemed clear. Borrow for crises. Repay during prosperity. But the lesson was short-lived. Wars kept returning. Borrowing became repeated, almost inevitable. The Civil War alone drove the debt from $65 million to almost $3 billion. Reconstruction and rapid industrialization kept levels high. World War I pushed borrowing to $22 billion. By the 20th century, debt ceased being temporary. It became a permanent feature of government finance. Borrowing was no longer reserved for emergencies alone. Instead, it became part of standard government planning. Obligations stretched far into the future. Patterns emerged. Rapid borrowing in crisis. Repayment when growth allowed. Then new borrowing for the next challenge. These patterns continue to shape the U.S. economy today. They influence how policy is made. They affect purchasing power, inflation, and the financial reality for citizens. To understand why America can print money yet still face financial pressure, we must follow this path through the 20th century and beyond. We will examine wars, domestic programs, and international agreements. All of them transformed the nation's finances and its role in the global economy. The pattern continued. Borrow in crisis. Repay in prosperity. Then forget the lessons when times were good. The Great Depression changed everything. Banks failed almost overnight. Unemployment reached 25%. Breadlines stretched for blocks. President Franklin Roosevelt responded with the New Deal. Public works projects built roads, dams, and electrified towns. Millions of jobs were created. Debt rose steadily, from $16 billion to $40 billion. But it was World War II that transformed America's finances entirely. Factories ran around the clock. Ships were launched weekly. Planes rolled off assembly lines by the thousands. Tanks and vehicles poured out. Debt exploded. From $49 billion in 1941 to $260 billion by 1946. That was more than 120% of the entire economy. No empire had ever carried such a load and survived. America did. Victory and global dominance played a key role. The dollar became unchallenged. Other nations relied on it for trade and reconstruction. In July 1944, delegates from 44 nations met at Bretton Woods, New Hampshire. Their goal? Rebuild a shattered world economy. At the center of the system, the U.S. dollar, backed by America's gold reserves. Other currencies were pegged to it. The International Monetary Fund and World Bank were created to maintain stability. America became a creditor, not just a borrower. Foreign governments and central banks accumulated dollars for trade, reconstruction, and security. This was called the exorbitant privilege. America could run deficits and borrow cheaply from allies without immediate consequences. It fueled decades of growth. The post-war boom spread across suburbs and cities. Interstates were built. Consumer culture surged. GDP tripled. Debt as a share of the economy fell below 40% by the 1960s. But cracks appeared. The Vietnam War drained resources. Welfare programs, Medicare, and Medicaid expanded. Deficits rose. Gold reserves declined as foreign holders exchanged dollars for bullion. By 1971, President Nixon faced a critical decision. The U.S. could continue gold redemption or end the system. He chose the latter. On August 15, 1971, the dollar stopped being convertible to gold. The Bretton Woods anchor was removed. Fiat money became the standard, backed only by government decree and Federal Reserve policy. Limits on printing ended, in theory. Deficits could continue without immediate gold-based restrictions. Inflation rose during the 1970s. Double-digit rates, gas lines, and stagflation challenged the economy. Paul Volcker, Fed chairman, raised interest rates to 20%. Mortgages became expensive. The recession was painful, but inflation was reduced. By the 1980s, the economy shifted again. Reagan-era tax cuts, higher defense spending, and Cold War priorities expanded deficits further. Yet markets continued to support the U.S. dollar. Foreign capital poured in. Japan and Europe lent eagerly. Exports of goods and debt sustained growth. America had created a system where borrowing and printing became tools for global influence. But as we will see in Part 3, these tools also created long-term pressures. Patterns emerge. Trust matters. And the lessons of history remain relevant today. History shows a pattern. Empires borrow, spend, and rely on trust. When trust erodes, adjustments follow. America is not different. Debt now tops $38 trillion. Interest payments exceed $1 trillion annually, more than defense spending in recent years. The dollar's share of global reserves has declined, from over 70% 2 decades ago to below 57% today. This is the fastest sustained drop in modern history. Social Security's main trust fund faces depletion by 2033. Medicare's hospital fund will feel strains soon after. Even optimistic projections warn of shortfalls. Printing money creates no real wealth. Only production does. When a country consumes more than it produces, the printer fills the gap temporarily. But eventually, the imbalance shows. America imports heavily and exports debt. Deficits are funded by foreign savings. The Federal Reserve manages the flow of money through policy and market operations. Markets, investors, and central banks monitor these policies closely. Interest rates, inflation, and currency value respond to each decision. Over time, repeated borrowing and stimulus create dependencies. Markets expect interventions during crises. Every rescue stabilizes temporarily but adds complexity to the long-term system. History shows that no empire survives without productive output. Rome, Spain, and Britain all borrowed heavily at different times. When confidence faded, debt became a crisis. For the United States, the cycle continues. Debt grows, obligations rise, and fiscal decisions matter more than ever. What does this mean for you? Your money may lose value when inflation rises. Retirement accounts may face strain if long-term obligations grow. Asset prices can fluctuate depending on interest rates and government policy. Real resilience lies in understanding history and diversification. Gold, land, productive businesses, and skills create long-term stability. These assets retain value regardless of monetary policy. Financial literacy is key. Understanding how the system works allows individuals to make informed choices. Monitoring government policy, debt levels, and market signals can guide better decisions. America's financial system is unique. It has tools unavailable to other nations. But those tools are not unlimited in effect. Trust, credibility, and productive output ultimately determine long-term stability. Today, unelected officials manage critical parts of this system. Their choices influence the economy, markets, and citizens' daily lives. The paradox remains. America prints money without a hard ceiling, yet obligations continue to grow. The dollar is powerful, but history reminds us that no system is immune to pressure. Understanding the past helps prepare for the future. It reveals patterns, highlights risks, and identifies opportunities. By watching trends in debt, spending, and global reserves, you can anticipate changes in financial conditions. You can protect your purchasing power and make decisions that are grounded in historical context. The story of America's finances is ongoing. Wars, crises, policies, and global influence all shape the trajectory. But one lesson is clear: knowledge, preparation, and careful observation are essential for navigating a complex financial system. If this overview helped you see the patterns more clearly, hit subscribe. The story of money is written in history, and understanding it gives you a clearer view of the present and future.